Our first presenter on Multi-Asset Flex is Rory Spanenberg. Rory, thank you so much for joining us this morning. Rory is going to focus on global multi-asset flexible, followed by head of Mark from Granite. They've got two mandates in SA Multi-Asset Flex and SA Multi-Asset High Equity. And then Mark Seymour also going to look at SA Multi-Asset High Equity. Mark, thank you for being here this morning as well. Rory, thank you so much.
Thanks, Eugene. Clients aren't greedy, they're human. And that also means that they're relative on the way up and absolute on the way down. I think your experience will probably attest to that. And that's, I think, particularly relevant in a global multi-asset flexible mandate such as ours, where we are quite equity-centric but very mindful of downside protection. So if you're looking to manage your client psychology, I would argue this is probably a product you want to consider, or at least a category. Harold Macmillan, the British Prime Minister, was asked shortly after he was elected what he expected his key challenge in government to be, and he responded to the journalist who posed that question that would be events. And having spent 27 years in some form or another in financial markets, there certainly have been a number of events and very eventful episodes along the way. And so what I thought I'd do today is just share some of the learnings from each of those, certainly from a bottom-up perspective, the lessons I've learned as a global stock picker. I realized on the plane this morning this chart should go back to 1998. I went to London, much like most graduates, and lucked a job at Merrill Lynch, April 1998, and on the 17th of August, the emerging market bond team that I had some dealings with all got fired because Russia defaulted on their debt. A few months earlier, the top traders in that team were all given brand new BMW Z3s as part of their bonus. So lesson number one is probably humility. The market provides plenty of humility. And the lesson is certainly from a macro perspective, is that over time it does go up. Certainly bear markets are generally far more protracted or bull markets are far more protracted than bear markets, and that's where one needs to have the courage of your conviction to act. And generally it's when it takes most convincing for you to get your clients either to remain invested or to make decisions that sometimes can feel counterintuitive. But as far as events and uncertainty goes, I'm going to get away from the air conditioner. I didn't realize sitting at the back earlier that what you meant, but now I do. As far as events go, unexpected things happen, and plan accordingly. That's why we diversify. Even as a stock picker, a record of a hit rate of 6 out of 10 is exceptionally good in global and domestic stock picking. And therefore, diversification, probably more importantly than that even, appropriate position sizing is, from a macro perspective, I think one of the key learnings. So let's flip it around and talk bottom up. I've got 5 stock examples to give you, and each one of them has provided some sort of lesson to me. The first is, look where others aren't. A great example of that is Blackstone, the global alternative asset management company. In June 2016, I was sort of casting my eye over global asset managers, looking for companies that met my definition of quality investments. That's to say that they used their capital efficiently and they had some evidence of a moat. Now, the barriers to entry in asset management are pretty low. But in the case of Blackstone, they had very, very favorable industry structural dynamics in their favor. Long-only active managers, many of us here today, were at the mercy of money fleeing public markets into alternative assets, and most of the money that remained in public markets was shifting to low-cost passive. Blackstone, through their relationship with over 1,300 limited partners, representing some of the biggest investors, sovereign wealth funds and public retirement systems in the world, and also because of their global and capability diversification, there was almost not a large alternative mandate in the world that they didn't have an entree to. So there was an evidence of a moat. But because of their complex partnership structure, the tax treatment of their dividend, they were not included in any indices. So benchmark cognizant asset managers were simply ignoring it. It traded on a little under 11's price to distributable earnings. That distributable earnings includes the realized performance fees that they earn. And that's another key part of the investment case. They were still able to convince their clients to pay them 2 and 20 pretty much. And at the same time, they had a very clear strategy as to how they were going to grow assets under management, but more importantly, make themselves less dependent on the harvesting and re-raising of capital by growing the perpetual part of their assets under management base. And so our effective holding period has been a little over 9 years, delivered a 964% return. It's beaten the average MSCI World Financial Company return, or the index return, by 16% annualized over that 9-year period. Lesson number 2, exercise strategic patience. TransDigm is a manufacturer of it's one of the highest quality industrial companies, in my opinion, in the world. It benefits from significant barriers to entry in that the certification of the parts that they manufacture, that process is very lengthy and time-consuming. It creates a barrier to entry for competition, not just in terms of the certification you require from the regulator, but also from the likes of Boeing and Airbus. And then you have very, very long product life cycles and runways from which to earn high-margin service revenues. When we first looked at it, it was trading at over $600 a share, EV/EBIT multiple of 18.5 times. Along came COVID. It collapsed along with the rest of the market. We were able to buy it at a little over $300 a share. And today it trades at $1,300. So outperforming the average industrial company by 18.5% annualized over 5 years. So know what something's worth, exercise strategic patience, and pounce when the opportunity presents itself. In markets, patterns and proxies abound. And what I mean by that is that it's very rare that you see something entirely unique. Through our investment in Blackstone, we were very aware of what is, I think, widely regarded as the most successful private equity investment of all time. Blackstone took Hilton Hotels private, separated the property assets into a propco and the operating company into an opco, and relisted that as an asset-light hotel company. So Hilton is again listed today. It was the precursor towards all the global branded hotel companies moving towards asset-light models, which greatly reduces the intensity of your growth because a dedicated landlord is providing the capital, or a franchisee. And so you have very efficient growth from a capital perspective. It meant that you could also broaden and widen your offering. So far more brands, far more across many more economic segments. And you've overnight effectively turned your business into a capital-intensive, cyclical entity. You've converted that into a company that earns fees, either from managing hotels or franchise fees, without the operating leverage of having to employ all the staff or own all the property. So royalty income without operating leverage. And so we'd seen that with Hilton. We had successfully owned Marriott. Accor is a French hotel company that have shifted towards a capital-light model. They're a little bit further behind in the evolution of that strategy. But since shifting to that model, they've returned close on 80% of operating cash flows to shareholders. in the form of dividends and share buybacks. So it's been a slightly more volatile ride, but the return total is close to 100% in US dollars on just shy of 5 years, 6% ahead of the average consumer discretionary company. So it's not all good news. When I took over the management of the Vunani BCI Global Macro Fund in April 2022, I inherited ASML. This is a company with a monopoly in extreme ultraviolet lithography. What that means is they manufacture the machines that print circuitry on semiconductor chips. They have 100% monopoly in EUV and close on 100% in total lithography. There's some competition from some of the Japanese. But even a monopoly is on its client base. And in this case, specifically in memory as opposed to logic, ASML were exposed to the likes of Intel and Samsung, very dependent on memory chips, which have been less buoyant than logic, and those that have been directed towards have seen the demand from AI. And its book-to-bill ratio, in other words, orders divided by revenue, has gone from 1.5 to 0.6. So it's delivering on its order book faster than it's taking in new orders. And a large part of that is dependence on two clients that are struggling, Intel and Samsung. But equally, geopolitics. The Biden administration and now the Trump administration have put an embargo on ASML selling its highest technology goods to China. And for that reason, orders have dried up and the shares underperformed. So even monopoly is dependent on its clients, key clients. And then Novo Nordisk, not quite a monopoly, but a duopoly. Much like Airbus and Boeing, duopolies are very dependent on relative market share as opposed to total market share. Airbus has been incapable of taking full advantage of Boeing's safety issues because of the long lead times to order and receive an aircraft, and they have very little pricing power as a result of that. In the obesity and diabetics sort of duopoly that exists between Eli Lilly and Novo Nordisk, similar. Novo Nordisk initially outperformed Eli Lilly quite comfortably, largely because of where they found themselves in the delivery of a quite exciting pipeline. But then through shortages and supply disruptions, they weren't fully able to capitalize on that. And Eli Lilly has caught up and now overtaken them. Trading between these two companies that exists on every piece of minutiae in terms of news flow that comes out as a result of that has ended up in quite a lot of volatility. The big story here is really the treatment of obesity as opposed to the comorbidities resulting from obesity. There's about 1 billion people that have been diagnosed as clinically obese, according to the World Health Organization. The treatment rates are exceptionally low, only 2%. The investment case for both these companies and therefore the total addressable market remains very, very attractive. If that treatment rate goes from 2% to 4% or 6%, there's more than enough for both of them to make a lot of money. Yet Novo Nordisk today trades on a forward PE multiple of 12, and Eli Lilly is closer to 40 times earnings. So all of that translates into long-term track record of our GIPS composite, of which the Vunani BCI Global Macro Fund is a component. There's a shorter history, long-term returns with downside protection, lower drawdowns, and a higher Sharpe ratio, firstly of the composite, which is not entirely made up of equities, it's only 80%, but certainly relative to the equity market as well. And then the fund itself is a slightly less appealing track record relative to the benchmark, largely because of when it was launched, only launched in July 2020. I took over in April 2012. We put a little bit of daylight between ourselves and the peer group, but I would expect that with a strong stock picking discipline and capital protection in mind, that we would also close the gap between ourselves and the composite benchmark. in the fullness of time. Speaking of time, I've given back 18 seconds.
Any questions from the audience for Rory? Rory, 2 questions very quickly. In a global flexible mandate, time to increase global bonds or US treasuries?
Well, we have, as part of the composite benchmark, a component linked to 3-month T-bills, and we are overweight that component. The very first slide in the presentation, the wonderful MSCI chart, I could have added that global equity valuations, PE ratios, are once again 1 standard deviation above long-run averages. Measures of risk, volatility is low. Credit spreads are tight. We are underweight again in global equities, having gone overweight for the first time in 3 years in early April. And we've reverted again and overweight in global T-bills and cash. Yeah, so defensively positioned. We also, I think, as I demonstrated in the equities, lean towards a quality style, and inherent in that is also an element of defense.
With some global managers, we're starting to see a bit of a trend where they start to diversify away from the US, going to markets like Europe, UK, some of them even Japan. You still sticking to US?
Well, the US makes up the largest component of the portfolio in absolute terms, but we're actually meaningfully underweight by about 10% relative to the MSCI World Index, and equally also technology. But that has been the case for the last 3 years, and it's been the wrong way to be positioned in hindsight. Our single largest overweight relative benchmark is in Europe, and to a lesser extent, Japan. What one needs to bear in mind, what the complexion of that exposure looks like, Europe has done incredibly well over the last to date, really, but a lot of that return has come from cyclical European companies, notably banks, Santander and UniCredit, for example. Last I looked, have delivered close on 100% returns in US dollars, which is typically not an area of the market that we would look at because those companies struggle to generate returns on equity above their cost of capital, cost of equity. Yeah.
Very, very last question. Very unusual for the Fed to indicate that they may be cutting rates when, again, the S&P is at an all-time high. What are they seeing that we're not seeing? Are they following the mandate of the labour market to try and prop up their labour market? Or what's going on?
Well, they're certainly coming under a little bit of political pressure as well. Not that they would necessarily respond to that, but they have a dual mandate to balance labour market conditions and inflation. Inflation, we'll note tomorrow, the latest inflation number. The market has moved very quickly to price in fairly meaningful rate cuts over the course of the next, I think a rate cut tomorrow, 25 or 50 basis points is almost certain in the eyes of the market. Not tomorrow, the next Fed meeting, yeah. But tomorrow's inflation number, which has proved to be quite sticky, closer to 3% than the 2% target, I think will be determinant. And that may itself present a bit of a problem to the financial markets, which have pretty much factored rate cut in. Yeah. Did I answer the question?
Yeah, you did. Rory, thank you so much. It was great having you here, and thank you for your time.
Pleasure.